Lehner, Office of Economic Analysis. And as Mark was saying, most of these different studies that have come out within the last couple of months show that there is an unequivocal positive impact on the economy from the legislation that's passed, primarily through, in the short term, because you're giving tax cuts to people who will spend money. So consumer spending will be larger. We'll see a little bit faster economic growth, a little bit faster employment growth and income growth. Certainly after-tax income growth is going up. Over the long term, a little bit positive outlook to the economy because we're raising the supply side of the economy, because with larger business investment, we'll have more equipment, we'll have more plants, we'll have more factories and things like that. The working productive capacity of the economy should be a little bit larger over the long run. So there's a positive economic impact due to this legislation. The relative magnitude of all of these studies that have come out show that it's relatively modest. We're talking about 0.1, maybe 0.2 percentage points increase in economic growth over the next 20 years, over the next 10 years, and over the next 20 or 30 years, a little bit less than that, maybe 0.1%. Our vendor has it at 0.06% per year economic impact of this legislation. Part of that has to do with the phase-outs, as Chris went line by line on a lot of these provisions. You get the near-term boost, but then they're all phasing out, and in some cases our taxes after 10 years are larger than they would be under the current baseline or the pre-legislation baseline, and so some of these impacts are muted longer term due to those provisions. So I think one way to think about this is long-run potential economic growth in the U.S. economy is somewhere around 2% GDP growth. That's somewhere where most economic forecasters are. Now, post this legislation, we're talking 2.1%, right? Every 0.1% matters. We're increasing the productive capacity of the economy over the long run. However, we're not talking about a substantial game changer when it comes to the outlook. And so the way we're going to feed this into our forecasting process, as the previous slide showed, is we're taking this U.S. economic forecast from 3,000 miles away, which we're letting them decide what the stock market forecast is, as Mark likes to talk about in front of the committee every 3 to 6 months. And we're allowing that to feed into the models, and how do we think that'll feed back into the Oregon economy. So again, a little bit faster GDP growth, a little bit faster employment growth. What is that going to do to the Oregon numbers? Probably similar types of effects, but we're just starting to vet this process. On Friday, we're meeting with the Governor's Council of Economic Advisors for the first time. Next week, we'll run the preliminary Oregon economic forecast. We'll reconvene our advisory groups and put that together in the coming weeks. What really matters when it comes to this sort of policy and the impact on the economy, particularly here in Oregon, is the timing. With the 2-year biennial window when it comes to the budget and the kicker calculations and all that sort of stuff, if we're juicing the economy up a little bit here in the next couple of years, that can impact the Oregon revenues from an economic point of view, potentially enough that it would push us closer to a kicker calculation. And so the timing here is what really matters. Again, over the long term, over the next 10 or 20 years, the economic impact should be relatively modest. That said, over the next couple of years, 2 of the major economic forecasters in the nation are saying, 0.2, 0.3% boost to GDP each year. Similarly, 0.2, 0.3% boost to personal income, things like that. So that should result in a stronger economic situation, more income taxes and corporate taxes flowing from the economic effects. However, what that'll do to the final numbers still yet to be determined as we work through our process.